Hello friends and welcome to Kirti Rane classes. In today's video, we are going to learn about the topic financial functions. Now, before we start the video, I would like to remind you guys that if you want to listen the exact same topic in Hindi, listen to the explanation of this topic in Hindi, please check out my channel playlist. I have explained the same exact topic in Hindi. So please also watch that video. So let us get started with today's video. In today's video, we are going to talk about the topic financial functions. Okay, so what exactly are financial functions? What actually are considered the function and what actually was included in? Let us get it. The financial function refers to the role, scope and duties of finance within a business. Over the decades, as the corporate world grew more complex, the view of what financial function should do evolved across three distinct stages. So what are these three distinct stages? So these are the first, the traditional approach that came in the early 20th century, the extensive transition approach that which lasted from 1940s to 1950s, and the modern approach which is from mid 1950s to present date, right? So we are going to learn about all the three approaches in this video. So let us get started. So before that, please take a screenshot. Okay, now the first approach is the traditional approach, which started in the early 20th century. Now the 20th century, do not consider it the 2000s, but the 1900s, right? That is the early 20th century. Okay, so the traditional approach emerged during the early 1900s and lasted until 1940s. During this era, the financial function was viewed from an outsider's perspective. What do you mean by an outsider's perspective? You do not view the financial function as a business owner or considering yourself as that business entity, but outside of that business. Now, looking at the firm from the viewpoint of the investment bankers, lenders and institutional investors, you are not participating in the management of the company. You are not that company, but and someone else who is going to invest in that. Okay, so what is the core focus? The procurement is the procurement of funds. Now, raising the money, that is the main job of the finance manager, was simply to find and secure capital when company needed it. Now, what was the core function for this traditional approach? It was the procurement of funds. That how should you raise that money? Okay, so what did the financial manager simply had to do? That where would you get the money? As you have known, the early business empires, whenever they pitched an idea, they did it for the money, right? So the main players for the finance were the banks, right? If you want to start a business, you would need to take a loan from the bank or the money lenders, right? So that was the main work of the main function of any finance manager to gain the money. Okay, so now we will look into more detail what does the traditional approach mean, but before that, please take a screenshot of this slide. Now moving on, in this traditional approach, the key occasions, right? We will first view the key occasions. Now this function became active only during the major corporate episodes, right? Like or milestones such as promotions, incorporations, expansions, mergers, reorganization or liquidation. So when did this traditional approach came into the view, or when it was at its highest peaking point? Whenever a business went through these things like the promotion, incorporation, that is whenever a business is going to grow or there is a chance of promotion within the business. Incorporation, when it means whenever business starts, right? Whenever you are going to start a business. Then expansion, whenever you want to expand a business, right? You want to start a business in the new locality. Then mergers, when two businesses merge together to form a new business or work on a new project. Then reorganization means the management went from one hand To another hand, right, someone buy they have reorganized the entire structure or liquidation. It means shutting down of the business. So in these moments, the traditional approach, or whenever they looked into the viewpoint, the lenders, money bank, right, they looked at the business, at the financial function during these peak points, right. These were the occasions at which the finance would function. Okay, now what were the major limitations in this traditional approach? We are going to look at that. So it completely ignores the internal management of funds, right. In the early 20th century, that is the 1900s, they only view that how would the whatever the external investment would be, how can we return that, but did not account for the fact that how the funds utilized internally. As long as you can give a return on that investment, you are successful, right. They do not see where internally how the funds were managed. Once the money was raised, how it was spent inside the firm was not considered a financial problem. Whatever you do, you can do. They do not consider how are they actually utilizing the money that they invested, right. They say just we have given you the money, we want this certain sum of return, right. How you do it, what takes you do, it's not our problem. So that was not considered in the financial function. Second, it ignores day-to-day working capital management, right. The company or in this traditional approach, the financial manager used to focus on the long-term benefits rather than the day-to-day working capital management. And the third, it treated finance as an episodic or occasional event rather than a continuous daily function, right. So in that time, what was the mentality? That if there are a few occasions or specific events which are listed above, like the promotion, incorporation, expansion, merger, reorganization or liquidation, in case of such events, we would need finance. But we do not need it on the daily basis, right? They would skip the part. Who needs finance for the daily basis? We would need them on the major occasions or the main events, right? So that was the thinking of a financial manager in this traditional approach. That's why it failed and changed into the second point. But before that, please take a screenshot. So this was all about the traditional approach. Now we are going to view the second kind of approach, which is the extensive or transition approach, right? Transitional approach, which lasted from the 1940s to 1950s. It lasted one decade, the 1940s to 1950s. It's also known as the Industrial Revolution period, right? Now, what happened in this actually approach, as the industries grew rapidly during and after World War II, the business operations became more sophisticated. The traditional approach was found to be too narrow, leading to extensive or transitional phase, right? So as we looked into the traditional approach, right, they only looked at the finance from the outside view. They do not consider the working or day-to-day capital. They thought that finance was only needed at these major events, right? But when did the World War II happen, and during and after World War II, they found out that it was too narrow to be used in this current time. So the new approach came, which is the extensive or transitional phase. Now what does it focus on? What is its core focus? So this approach extended the traditional view by acknowledging that finance is a continuous day-to-day operation and not just an episodic event, right? So what happened during the traditional approach, right? It happened that whenever a finance manager would be in the company, they would not say that, oh no, we need a finance for day-to-day activities. They would only say that we would need finance at the start of the business, if you want to expand, if you want to do promotions inside the company, etc., right? So they would need finance for only these major activities. But in this period, where after the World War II, during and after the World War II, whenever there was a great economic crisis, they learned that finance is not something that only relies on these major events. It is a day-to-day activity. look into the finance on the day-to-day basis, it is if you not look at it as a continuous activity, it would become a very harmful for the business, right? So the main core focus that the traditional approach neglected and the extensive or transitional phase accepted. Okay. Now, before we move on to the next points, please take a screenshot. Now we will look how this extensive or the transitional phase was, what key features did it had in this approach. Okay, the second kind of approach, the extensive and transitional phase approach. Okay, so the key features, it began incorporating routine internal financial tasks into finance functions. Okay, the scope widened to include bookkeeping, financial reporting, managing cash inflows or outflows, and maintaining the financial health needed to safeguard the company's assets. Now, before that, they only looked into the finance whenever major events happened, like the incorporation, liquidation, promotion, expansion, right, mergers, reorganization, right? But in this, they accepted that finance is a continuous activity. It should be recorded on the day-to-day basis, and therefore the system of bookkeeping emerged, right? Because the bookkeeping emerged, the financial reporting and the managing of inflows and outflows of cash was also taken into the consideration, and the maintaining financial health was considered a priority in this approach, the extensive or transitional phase approach. Okay, so these were the key features of the second type of approach, which is extensive approach. Okay, now what were the major limitations in this approach? Because without limitation, we may not think of improving it, right? We have improved it means it has limitations. Now, what about the major limitations? While it recognized the everyday nature of money management, it was still primarily descriptive and institutional. It focused heavily on gathering data and maintaining liquidity, but it lacked the analytical framework for making critical investment decisions or optimizing capital structure. Okay, so what was wrong with this approach? What were its limitations? So it only viewed finance as a descriptive, as an institutional, right? It was still viewing it as that. It lacked the analytical framework for making critical investment decisions. It did not say that if we are going to start this project, how much return would we get in how many years? How much time would it take to get our investment back from this particular project? Is it and risk for our business, right? Do we need more finance? Do we have to raise finance through owned funds, or we have to raise finance through borrowed funds, right? So this analytical approach was missing in this extensive approach. Okay, so therefore it lasted a decade from 1940s to 1950s. Now, after 1950s, a new kind of approach came, the third kind of approach. But before we start that, please take a screenshot of this slide. Now, moving on to the third kind of approach, which was the modern approach, which started from the mid-1950s and is lasting till the present date. Okay, so let us view into it what is exactly the modern approach. The modern approach, which began taking shape in the mid-1950s, revolutionized the financial function. It shifted the perspective from an outsider looking in to an insider looking out. Finance was no longer about procuring funds. It became about the efficient allocation and utilization of those funds. Okay. So till the first two approaches, the traditional approach and the extensive approach, what happened was it was still viewed as an outsider looking into the business. If you were an investor, would you invest in that particular project or not? But in this modern approach, it became that no, we are the business. We are going to run this business. Is this project beneficial for our growth or not? So till 1950s, till the mid-1950s, it was an outsider and lender looking into the business and just concerned about how would they get the returns, right? So the main focus of those two approaches was the procurement of funds, but the main focus of this modern approach is how efficiently and effectively you utilize those funds so that your business can grow. Now we will look at the core focus of this approach. Now the core focus was solving the twin problems of risk and return. The modern finance manager is a core strategic decision maker involved in both sourcing money and deploying it productively to maximize firm value. Okay. Now what was the core focus of the modern approach? Now there are the problem while investing, right? You will have to take a look at the risk that you're undertaking while in this investing in that particular project, and how much return would you get. So you need to analyze both of these aspects before the investing, right? Before using the funds to invest in that particular project or that particular asset, right? So today's modern finance manager is a strategic analyst that analyzes these two things and then would use those funds, right? That's the function of a financial manager in this modern approach or in this today's world. Okay. So before we move on to the next points, please take a screenshot of this point. Now, how was the modern approach? What does it actually include? So we are going to view that this modern approach includes 3 core decisions. Now let's look at it one by one. The modern approach frames the financial function around 3 critical continuous choices. First is the investment decision, financing decision, and dividend decision. Now what are these 3 decisions? Now the investment decision is where should the firm invest in its limited capital to earn the highest return. Now how is it calculated? It's calculated using the advanced analytical tools like NPV, IRR, and payback periods. Okay, now what exactly is this investment decision? It asks a question that how can we invest the limited, the scarcity of the funds that we have, the limited small funds that we have, so that we get the highest, the maximum amount of return as possible while keeping the business safe, right? It is not to indulge in too much of the risk and gaining the highest return possible on the limited resource that you have. So that is the investment decision. Now how do you calculate it? You calculate it with the following methods, which is NPV, IRR, and payback periods. We will learn about it in future. Okay. Now the second is financing decision. Now what exactly is financing decision? Let us look into it. So what it poses the question, what is the optimal mix of debt and equity that minimizes the overall cost of capital? That is, what is the cost of equity and cost of debt, okay, KE and KD. Okay, so it poses the question, how should I make my capital mix, right? What should consist in my capital mix? Should the 80% be the owner's funds or 20% be the debt, or should it be like 50-50, 60-40? Yeah, you need to calculate that, whether the cost of the equity is and the cost of debt, how is it? Is the cost of debt greater than the cost of equity? Then you should not take a debt but the equity, right? If the cost of debt is smaller than the cost of equity, you will prefer to source the funds from a debt source, right? So that is the financing decision, that how are you going to make your capital structure. Okay. The next is third, the dividend decision. Now what does the third dividend decision poses? It poses the question, how much of the profit should be distributed to the shareholders versus how much should be retained for internal growth. Now it poses a question on whatever you earn. Now whatever you earn is actually your net profit. Now you would need to pay back to your owners, right? They should feel a sense of appreciation. They should be rewarded because they have invested in your company, right? They should feel like, yeah, I have did the right thing by investing in this company, right? So you will have to pay certain amount of sum, and that is known as dividends. Now the question poses is, how much of the profit are you going to distribute as a dividend, and how much of the profit are you going to retain in the business for your future use, for your growth. Okay. So sometimes the business has to take a decision that this year we are not releasing any dividend because we need to expand in the next year, right? You propose this idea to the shareholders, etc. So this is all what the dividend decision is all about. So these are the three core decisions in our modern approach. The investment decision relating to how you use the funds, the financing decision, how you source the funds, and the dividend decision, and how you distribute your earnings. So these are the main three decisions in the modern approach. Please take a screenshot of this slide so we can move on to the next point. Then last, we will view at the summary of all the three decisions. Okay. So comparing all the three approaches of the finance functions, right? Financial function. Now first column we have the features. The second column tells us about the traditional approach, extensive approach, and then the modern approach. Okay, so we will be looking at it one by one. The first is the primary outlook. Now what is the primary thing that these approaches look into while considering finance as a function? Okay, in the traditional approach, the primary outlook, or the person who is looking into the business, is actually an outsider. Okay, who would invest in the business, the lenders, the bank managers, right, etc. Now in the extensive approach, it is the routine internal operations, that how much are you going to actually use in the daily basis. Okay, and the third, in the modern approach, it is the insider strategic point of view, that how much would it actually help us to grow. Okay, so first was how much return would I get as an outsider investing in the business. Second was how should I use the money that I got, okay, in the business so that it sustains, right? And the third was how should I use this money so that I would grow more and become number one in that industry. Okay, so this was the primary outlook. Second is the core objective. Now the core objective of the traditional approach was sourcing finance for specific events. Now we have looked into the specific events. What were they? They were promotion, incorporation, liquidation, merger, reconstruction, etc. Right? So these were the some of the specific events. So how would you source funds for those specific events? Second is the extensive approach. The core objective was maintaining daily liquidity and records, right? They understood that no, we actually have to look into day-to-day operations. We have to look into the day-to-day cost. So how are we going to manage that? So that was maintaining daily liquidity and records. The third, in the modern approach, it is the maximizing the overall wealth of the firm. That is in turn the wealth maximization concept. Okay, so this were the core objectives. The third point is the nature of work. Now in traditional approach, what was the nature of work? It was occasional. Okay, it would happen only on certain times when a certain event occurred. Okay, next is the extensive approach. It was continuous, but it was descriptive, right? You will use it, you will keep a track record of all the things you do on the daily basis, but it was not analytical. Okay, it was descriptive. Yeah, we have spent this much today and we have gained this much today. That was the condition. In the modern approach, it is continuous, analytical, and conceptual. In this, you do not only keep the track record, but you analyze that if I were to invest in this particular project, this amount of sum, would it actually benefit me or not? That's why it is analytical and conceptual. Now the key question asked in all the three approaches. The first approach asked the question, where do we get the money for expansion, or where do we get the money for our certain kinds of events, right? The second extensive approach asks, how do we track the daily cash flow, right? How would I know that how much money I spent on this day and how much money I gained on this day, right? And the third, the modern approach asks the question, how do we allocate funds so that we can get more and more profit, right? So how to allocate funds so that we can get the highest return possible. So these were the key questions asked by each of these approaches. Hopefully you understand this thing, and please take a screenshot of this table so it would be useful for your exams. With this, our topic, the finance functions, have been completed. Thank you for watching this video, but before that I would like to remind you that I have explained the same exact topic in Hindi. So don't forget to check out my channel playlist so that you can watch the same topic in Hindi and get a clear idea about the topic. Thank you for watching this video. If you like this video, please click on like, subscribe my channel for further updates, share it with your friends and comment under it how do you liked it. Thank you.